The capital rotation has begun. Specialized sector leaders are coughing while broader indices barely register a fever spike. A signal just triggered that hasn't been seen since late 2025, and it changes how every tech-exposed portfolio performs from here forward. The question isn't whether this is normal volatility. It's what specific exposure will survive the next distribution wave. The Magnificent Seven are running hot despite the headline noise, but their concentration risk is exposing portfolios to sector-specific shocks. ARKK shed 1.14%, while MAGs dropped a steeper 77% as capital rotated out of semiconductors and into defensive biotech. SMH, the semiconductor engine, pulled negative by 0.50%, confirming that chipmakers led the selling pressure. The consensus among the Canary community is that megacap growth ETFs have become overexposed to a single industry, making them vulnerable when earnings disappoint or guidance contracts. Regional banks are coughing today as CRA dropped 1.63%, the worst performer among sector leaders. Exchange-traded funds and equity futures retreated before the bell, with Robinhood dropping 4% and Webull tumbling 6%. The data confirms that retail brokerage stocks have become a secondary drag point after semiconductors, likely due to margin compression concerns and potential regulatory scrutiny around fractional shares. High-yield bonds held steady at 1.51%, but the pulse check shows credit is still functioning. Just cautious. UVXY surged 4.11%, while VIXY climbed 2.77%, confirming that vol products are responding appropriately to today's pullback. The VIX index itself jumped 7.47% despite the S&P 500 only losing 0.59%. Our metrics confirm this as a textbook fear spike. Volatility is priced in, but not at extreme levels like we saw during 2022 or early 2023. The indicators are signaling that investors expect further downside before stabilization, hence the rotation into safe havens and defensive sectors. XBI, the biotech sector, surged 1.48% as capital flowed defensively away from speculative tech exposure. Consumer discretionary held nearly flat at 0.18%, suggesting core consumer spending remains intact despite the broader sell-off. The real economy is showing resilience in consumption, while specialized sectors take the heat for valuations. Gold moved up 0.84%, and TLT gained 0.44%, confirming that safe haven assets are attracting demand from risk-averse flows. Bond, GLD and TLT all posted gains as portfolios rotated into defensive positioning. XLP consumer staples edged down only 0.26%, while holding relative strength versus the broader market. The safety trade is working as designed. Investors are hedging against further downside, without abandoning equity exposure entirely. Our data indicates that this is tactical rather than structural. Portfolios are building immunity, not fleeing the asset class altogether. The hero today is your diversified portfolio with low beta exposure and sector hedges in place. The villain is concentrated megacap growth, specifically semiconductor-heavy ETFs, that have become overextended after a decade of steady appreciation. Tech is coughing hard, but not flatlining, while vol products and defensive sectors are building the immunity needed to weather what's coming next. The verdict is clear. Today's move was sector-specific weakness in tech and banks, rather than systemic failure. Portfolios with exposure to diversified megacap growth and semiconductor-heavy ETFs will face near-term headwinds, while those positioned defensively through biotech rotation and volatility hedging are better equipped for what follows. The Canary dashboard shows fear is priced, but not panicked. Expect further distribution before stabilization.